Welcome back. Today we are going to see the difference between historical volatility and implied volatility in options market. So what is the actual difference between these two? So this is the pricing Black-Scholes-Merton model pricing formula. So we all know we need volatility as one of the input factors in pricing options. So the volatility number which goes into options pricing model is predominantly historical volatility. So where do this historical volatility comes from? This historical volatility comes from the underlying stock prices. In this case, if it is a last 30-day return, it will be the standard deviation of the last 30-day returns. We call it as the volatility. So and we plug it into the options pricing model and we get the options price. If it is a call option price or a put option price, we get it respectively. So why we need implied volatility? What is the basic difference between these two? So the historical volatility predominantly speaks about the underlying volatility, but the implied volatility is nothing but the actual volatility of the option prices itself. So if the underlying volatility is 10%, so the option doesn't have any conditions to trade at the same volatility. So it can trade at a volatility different than historical volatility too. So let's see an example. So if the historical volatility of Apple stock price in US stock markets is 10%, so the option of a particular call option, say for 100 strike, can be at 15 or 20%. If the market feels that the significance of price uptrend is still moved, there will be more demand for the call options. So the price will increase. So of course the volatility will increase too. So whenever there is a difference between these two volatility numbers, that's where the actual trade happens. So for example, if the historical volatility of Apple stock price is 10%, but the options are trading at predominantly higher implied volatility. So what does it mean? So the options are trading at a very high premium because there are a lot of people buying in the markets. To put it in a simpler way, there is a lot of demand for the options. Say for example, if it is a call option, the people are predicting an up move. The high implied volatility is nothing but the options are trading at a very high premium. So what actually it means, so these IVs are usually mean reverting. So what do they mean revert to what levels? The implied volatility usually mean revert to the historical volatility numbers. So if the implied volatility is higher than the historical volatility, so it will revert back to the historical volatility numbers. Even in case if implied volatility is very low, in that case the option prices will be low, so it will be revert to the historical volatility numbers. So that's where the takeaway is: implied volatility is not equal to the historical volatility. Implied volatility can be higher. Whenever there is an higher implied volatility, the option prices usually fall in value, and whenever there is a low implied volatility, that's a good chance for buying the options because the underlying predominantly has higher volatility. Thank you. Hope it makes some sense. Please keep watching. Thank you.